Why do most investors pour their money into real estate, stocks, and tech startups, yet completely overlook franchising, even though franchising has created some of the most predictable wealth in modern history? And why do private equity firms aggressively acquire franchise platforms while individual investors rarely consider even owning equity in them? I'm Justin Kaiser, co-founder of Empire Franchising and CEO. And over the last 24 years, I've built businesses, structured equity deals, and scaled franchise platforms, including scaling my own franchise system from 0 to over 100 franchise territories before an exit. What I can tell you with absolute certainty is that franchising remains one of the most misunderstood, underappreciated, and undervalued asset classes available to investors today. Not because it doesn't work, but because most investors don't understand how wealth is actually created inside scalable systems. You see, most investors are trained to think in terms of passive assets, stocks, bonds, real estate, things that hopefully appreciate over time. But franchising operates differently. Franchising is not just an asset, it's a system that manufactures assets. It creates new revenue producing units over and over again without requiring proportional capital. That distinction changes everything, because when you own equity in a franchisor, you don't own one location, you own the platform that creates locations. Imagine the difference between owning one rental property versus owning equity in the company that sells and collects royalties from thousands of rental properties. That's the difference between thinking like an operator and thinking like a platform owner. And the platform ownership is where the real wealth is built. So, here's why franchising is so powerful. Franchisors generate revenue from multiple layers simultaneously. They collect revenues from upfront franchise fees, ongoing royalties, territory fees, renewal fees, and transfer fees. Also, vendor rebates, training revenue, and most importantly, enterprise value expansion as the system grows. The most powerful part, though, is that the franchisor does not fund the majority of expansion. Franchisees do, which means that the franchisor scales with dramatically less capital than traditional businesses. This is capital efficiency at the highest level, and capital efficiency is what drives exponential returns. Private equity understands this deeply, which is why they buy franchise platforms in groups. They acquire one franchisor, then they optimize systems. Then they accelerate franchise sales and expand unit count. What also happens next is the royalty revenue increases, and then they sell at a multiple of EBITDA. And those multiples expand as predictability increases because franchise revenue is recurring, it's contractual, and it's diversified across many operators. This reduces risk, it increases valuation, and it creates leverage at the platform level. But most individual investors never see these opportunities because they're not structured or presented in ways that they understand. And they're not taught to think in terms of platform equity. They're taught to think in terms of individual investments. Buy a property, buy a stock, buy into a startup. But franchising operates in the middle ground. It combines the predictability of real estate with the scalability of software and the cash flow of operating businesses. And that combination is extraordinarily powerful. Let me give you a quick example. If a franchisor sells 100 franchises and collects a $50,000 franchise fee per unit, that's $5 million in franchise fee revenue. Then assume each franchise generates $1 million per year in revenue and pays a 6% royalty. That's $60,000 per unit per year. Now, across 100 units, that's $6 million per year in recurring royalty revenue. And that revenue continues year after year after year as the system grows to 200 franchises, 500, 1,000. Enterprise value expands dramatically because valuation is driven by predictable recurring revenue. This is why franchising has created some of the largest wealth outcomes in business history. McDonald's, Subway, Anytime Fitness, Orange Theory, all built on this exact model. And yet, most investors never participate at the franchisor level. They only see franchise ownership at the unit level, which is fundamentally different. Owning a franchise unit can be a great business. I'm not knocking it. But owning equity in the franchisor, that's the ownership of the expansion itself. That's ownership of the machine that generates growth. This is where leverage compounds, because each new franchise sold increases revenue without requiring proportional cost increases. This creates operating leverage, margin expansion, and valuation expansion simultaneously. When investors understand this shift, their perspective changes permanently. They stop thinking like buyers of assets and start thinking like owners of platforms. And platforms create asymmetric upside because they scale without linear constraints. When I got into the franchising space, I saw firsthand how predictable and scalable it was. I saw how systems could replicate across markets, how franchisees invested their own capital to expand the network, and how the franchisor's value increased exponentially as the system grew. Once you understand this, you realize that franchising is not just a business model, it's a wealth creation framework. It's a structure designed for scale. And the reason that most investors overlook it is not because it lacks opportunity. It's because it requires a different lens, a different outlook. It requires thinking in terms of ownership of systems, not just ownership of assets. And once investors make that shift, they begin to see opportunities that others miss. They begin to understand why private equity firms aggressively acquire franchisors, why valuations increase as unit count grows, why recurring royalty revenue creates predictable cash flow, and why platform ownership creates long-term wealth. The future of investing is not just owning things, it's owning systems that produce things, systems that replicate, systems that scale, systems that create predictable recurring revenue. Franchising is one of the most proven structures ever created to accomplish this, and those who understand this position themselves at the ownership layer, not the participation layer. If you want to learn about how franchising works at the platform level and how investors are positioning themselves to create and participate in this asset class, then visit empirefranchising.com and subscribe to this channel, because I'm going to continue breaking this down, how scalable systems create wealth and how you can begin thinking like a platform owner, not just an investor. That distinction changes everything. Because when you own equity in a franchisor, you don't own one location, you own the platform that creates locations.